All right, let's talk about one of the most powerful and maybe one of the most misunderstood tools in the financial world, options. Now, forget the complex charts and all the Wall Street jargon for a second. At their core, options are really just contracts. But they're special contracts that let you, well, almost surgically design your own financial outcomes. So let's dive in. I want to start with a question. Just imagine this. What if you could control $12,000 worth of a really hot stock, but you only had to put up $300 to do it? I mean, that sounds almost too good to be true, right? Well, this kind of leverage, this kind of power is exactly what options are built for. First up, let's talk about the call option. The easiest way to think about this one is as your offensive playbook. It's how you can capture some really massive upside potential. And to make this concept totally clear, we're actually going to step away from the stock market for just a minute. So let's meet Sammy. He's found his dream house, and it's owned by Susie. The list price is $500,000. Sammy thinks it's an incredible deal, and he wants to make a move, fast. But here's the snag. Sammy's money is tied up. He won't have the full $500,000 for another 3 months. And he's got this nagging fear that in that time, another buyer's just going to swoop in and the house will be sold right out from under him. He needs a way to lock it down. So Sammy gets creative. He goes to Susie with an offer. He says, I'll give you $5,000 right now, cash. In exchange for that cash, Susie agrees to give Sammy the exclusive right, the option, to buy her house for that agreed-upon price of $500,000, anytime he wants within the next 3 months. Okay, so a month goes by, and then something amazing happens. The city announces they're building a huge, beautiful new park just down the street. And just like that, the value of every home in the neighborhood skyrockets. Susie's house, it's now worth $600,000. And this is where you see the magic happen. Sammy exercises his option. He gets to buy a house that's now worth $600,000 for the price he locked in a month ago, $500,000. Think about that. For just $5,000, he controlled a $500,000 asset and instantly captured $100,000 in new value. And right there, in that little story, is everything you need to know about a call option. Let's just put the official labels on it. That $5,000 Sammy paid, that's the premium. The locked-in price of $500,000, that's the strike price. And here's the most important part. Sammy had the right to buy, but he was never obligated. If, say, a sinkhole opened up and the house's value crashed, he could have just walked away, only losing that initial $5,000. Okay, so you get the concept, right? Now let's just swap out Susie's house for shares of a stock and see how this plays out with a real-world company like Nvidia. Let's say Nvidia is trading at $120 a share, and you've got a feeling it's about to take off. Now, instead of forking over $12,000 for 100 shares, you buy one call option contract for just $300. This contract gives you the right to buy 100 shares at a strike price of $130. Then, boom, just like you thought, the stock rockets up to $145. So you exercise your right, you buy those shares at your locked-in price of $130, and you can immediately sell them for the market price of $145. You subtract your initial $300 cost, and you've just made a $1,200 profit. So that's how you play offense and go for those big gains. But what about defense? How do you protect the money you've already made? Well, for that, we have to flip the coin over and look at the put option. Honestly, the best and simplest way to get your head around a put option is to just think of it as an insurance policy. It's a tool that's specifically designed to protect your assets from a disaster. Let's bring back our friend Sammy for this. This time, Sammy owns a truck, and it's worth a solid $40,000. The only problem is he lives in an area with a lot of car theft, and he's constantly worried he could wake up one morning and his entire investment could just be gone. So what does he do? He does what any of us would do. He calls up an insurance company and pays them a $1,500 premium. In exchange, he gets a 1-year policy that protects the full value of that truck. I think you can probably see where this is headed. A few months later, his worst fear comes true. His truck is stolen. But because he had that policy, the insurance company cuts him a check for the full $40,000. He paid a small, known, manageable fee to protect himself from a huge, catastrophic loss. And that is exactly what a put option does for your stocks. It's a contract that gives you the right, but never the obligation, to sell an asset at a locked-in strike price. Sammy's insurance policy was, for all intents and purposes, a put option on his truck. So here's the key takeaway. A put option literally puts a hard floor under your potential losses. It establishes a price below which your asset's value cannot fall for you. So imagine you own a stock that's run up a ton, but you're getting nervous about a bad earnings report. By buying a put, you can lock in your gains. If the stock crashes, who cares? Your put is a safety net that lets you sell at that higher pre-agreed price.
Okay, we've covered a lot. We've talked about buying calls to bet on the upside and buying puts for protection. So now let's pull all of this together and look at the 4 fundamental moves you can make, all depending on what you think the market's going to do next.
It really breaks down this simply. If you are bullish, you think the price is going up, you can buy a call option, just like Sammy with the house. If you're bearish, you expect a fall, you can buy a put option for protection, like the truck insurance. But notice the other actions on the table there. You can also sell these options to other people and collect the premium. This is a whole different ballgame, and it comes with a completely different set of risks. And this brings us to something that is absolutely critical to understand. When you go from being an option buyer to an option seller, your role completely flips. And so does the risk. Here is the single biggest difference, and you have to get this. When you buy an option, you're buying a right, and your risk is capped. The absolute most you can lose is the premium you paid. That's it. But when you sell an option, you are taking on an obligation. Think about it. If you sell a call option on NVIDIA, you're promising to sell someone 100 shares at a set price. What happens if that stock goes to the moon? Well, you are still obligated to sell at that lower price. You'd have to go out and buy the shares on the open market at some astronomical price just to make good on your deal. And that's how your potential loss becomes, literally, unlimited. Okay, let's zoom out one last time. I want to focus on the single most powerful concept that really makes options a total game changer for investors. It all boils down to one word: leverage. Just remember our NVIDIA example. A $300 investment gave you control over a $12,000 position. That tiny initial cost led to a $1,200 profit. That's a 400% return on your money. That magnification of both risk and reward is the core power of options. So when you really think about it, options move you way beyond just buying stocks and crossing your fingers. They are precision instruments. They give you the ability to mathematically design your own risk and your own reward for almost any scenario you can imagine. And that really just leaves us with one final thought. If you had the tools to precisely shape your own financial destiny, what would you build?